Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems for Chapter 7, the short exercises. Let me get my pen here. Right, note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so let's jump down here to short exercise 7-6. And where's that pen? Again, okay, here we go. It says here, match the term with the definition by placing the corresponding letter in the space provided. So let's do it from this perspective. I mean, we have creditor, debitor, receivables, bad debt expense, allowance method, allowance for uncollectible accounts, percentage of sales method, aging method, and direct write-off method. And so we need to look through here. It says example. Let's see, 1, 2, 3, 4. Oh, there's 8. 1, 2, 3, 4, 5, 6, 7, 8. There's 9 here. So they used C here as a receivable. All right. So the receivable is gone. All right. Amount owed to a business by another business or individual. Yes, that's a receivable. So that's letter C. Okay. A contra account relates to accounts receivable that holds the estimated amount of uncollectible receivables. Well, that would be our allowance for uncollectible accounts. So this would be F. A method of accounting for uncollectible receivables. So this is a method for collecting uncollectible, a method of accounting for uncollectible receivables. So it's a method in which the company waits until a specific customer's accounts receivable is uncollectible before recording the bad debt expense. So that would be the direct write-off method, meaning they're waiting until it's a bad debt, then they directly write it off, and that's a method. So that would be I. A method, again, a method of recording receivable losses on the basis of estimates instead of waiting to see which customers the company will not collect from. Okay, that would be the allowance method. All right. Because why? We're kind of saying, okay, we're making it, it's a method first, and we're making an estimate as to what would be bad debt. We're not waiting for it to come off. Remember, the allowance method and the direct write-off method are the two methods for estimating uncollectible, for recording, or, for paying attention to our bad debts. 4. The party to a credit transaction who sells goods or service and obtains a receivable. Okay, so the party to a credit transaction who sells goods, all right, so if somebody is selling the goods and it's a credit transaction, so they're extending things on account, so that would be a creditor, right, because they're the ones who are extending the credit to allow the transaction because they're selling the good, right? And the person who is paying that off, the person who's buying that is the debtor, right? So that would be, let's see here, the party to the credit transaction who makes a purchase and has a payable, all right? So that would be B down here, would be our debtor, the opposite side of the same coin, our accounts receivable versus our accounts payable. Right, a way to estimate uncollectible accounts by analyzing individual accounts receivable according to the length of time they have been received. Okay, so that's an aging method. Okay, it's the length of time, meaning how long that those receivables, whether it's in the 30-day, 60-day, 90-day, 120 period, 120-day period. You're aging, and you're estimating from that aging. cost to the seller of credit sales arises from the failure to collect from a customer, right? So that would be a bad debt expense because, we didn't receive the money, right? So, that's ends up being a cost to us, a bad debt expense. Expense is a cost to the business. And then, of course, a method of estimating uncollectible receivables that calculates bad debt expense based on net credit sales. So that would be percentage of sales method, G. Short exercise 7-7, direct write-off method, right? Amy McIntosh, an attorney, uses direct write-off method to account for uncollectible receivables. And that means as soon as she determines that that customer is not going to pay their debt, she directly writes off that receivable to bad debt. On September 30th, McIntosh's accounts receivable were $16,500. During October, she earned service revenue of $21,000 on account and collected $19,000 from clients on account. She also wrote off uncollectible receivables of $1,600, right? So that's all data that we're getting, all right? Information that we're getting. What is McIntosh's balance of accounts receivable on October 31st? Okay, so that's what we want to know. Does she expect to collect this entire amount? Why or why not? All right, so the easiest way to do this is to create a T account for our accounts receivable, because that's the account we're looking at. All right, so it says here on September 30th, her receivables were $16,500. So she had $16,500 on 9/30. That's what her receivable account says. Then it says during October she earned service revenue of $21,000 on account, meaning she had however many customers, and whenever she had a customer, she extended it on account. So she was debiting her accounts receivable and crediting her revenue account, right? And the total of all of those transactions ended up being $21,000 for her accounts receivable. So during October, when she made all of these journal entries and they were posted to the accounts receivable account, her accounts receivable increased by $21,000, for the month of October. These were services. Okay, then it says here, and she collected $19,000 from clients on account. Okay, well, when she collects from the clients, right? In other words, the customer pays off their bad debt. What does she do? She debits her cash and she credits her accounts receivable, right? And in this case, it was to the amount of $19,000, right? So if she collected $19,000 on account, so we have $19,000 collected. Now that's a credit to my accounts receivable. So when I posted these entries, right, I'd end up crediting the accounts receivable. Now, it says here she also wrote off uncollectible receivables of $1,600, right? Well, remember, she's using the direct write-off method. So as soon as an accounts receivable is bad and she no longer, she knows she's not going to collect it, she has to make a journal entry, all right? And what is she making that journal entry to? Well, she's going to credit accounts receivable because she's writing it off. It no longer should be on her accounts receivable, and she's debiting bad debt expense. In this case here, it was for however many customers. It ended up being 1,600. So when she was making those journal entries, she's crediting the accounts receivable in the amount of $1,600 as write-offs directly to bad debt expense. And so what is McIntosh's balance on October 31st? Okay, so we add up our debits and we add up our credits and subtract one from the other, and when we do that, we end up with $16,900 as her new balance on October 31st in her accounts receivable account. It says here, does she expect to collect this entire amount? Why or why not, right? Does she expect to collect this $16,900? Why or why not? Realistically, you're not going to collect this full $16,900. It's unrealistic to expect all of your customers 100% of the time to pay off their accounts receivable. You're always going to have, some kind of bad debt in there. Okay, I mean, if you only had one or two trusted customers that, even if they fell behind, you would know that, you talk to them and they get it right, and they say, okay, look, I'm stuck a little bit. Can you? And you say, yeah, okay, fine, because they were good. Well, then yeah, you would know that you could say, oh, I'd collect 100% of my accounts receivable, but you're only talking about one or two customers. But when you start getting any volume of customers that you extend credit to, it's you can't expect to always collect. You're going, 100% of that debt. All right. There's always going to be someone who is not going to pay. All right. The more customers you have, the higher probability that you run into that situation happening. So if you have a few customers, well then yeah, and if I looked at I graph it out, okay, and I had this here as this here's the number of customers and the percent of bad debt here, okay. Well, if this is 0, and of course we're going in this direction, right? So let's stick a number on here as 100. Well, and this is 1. Well, the percentage of bad debt is probably going to be very, very low right here. But as we have more and more customers, the chance of that percentage going up, even if that, let's just call this here, make this mark, and let's just call it, say, 2% right here, okay? The number of that's what a graph would look like, of the number of customers and the percentage of customers that would end up being bad debt. All right, and so the greater the number of customers, the greater the chance of having that bad debt. And that's what it would look like on a graph. All right, so yeah, that's it for this video. I will stop here and pick up in the next one for problem 7-8. If you have any questions, feel free to contact an instructor.